What if one of the fastest growing housing markets in California is rising because of something that still doesn't exist? That's the situation right now in the Central Valley. In April 2026, Fresno is seeing a wave of new luxury condos. We're talking rooftop decks, fitness centers, smart home features, resort-style amenities that didn't exist here just a few years ago. Prices are up more than 40% compared to last year. Some units are now selling for over $500,000. And that's not just a small jump. That's a massive shift in what this market used to be. But just a few miles away, the high-speed rail stations around which these homes are built are still not finished. Some are just empty land. Others are stuck in early construction. No trains. No confirmed launch date. No clear timeline you can actually count on. So why are prices going up so fast? And more importantly, who is really driving this market? Let's take a closer look. This all starts with what we can call the Central Valley Hype Engine. Developers are using a strategy called the 2026 benchmark. The message is simple. Buy now before prices go even higher. They claim that once high-speed rail connects the Central Valley to major cities, home values could jump another 30 to 50%. And that's a powerful story, because it taps into something buyers don't want to miss: the fear of getting priced out. So, instead of pricing homes based on today's reality, they're pricing them based on a future that hasn't happened yet. And that changes everything. Let's slow that down for a second. When pricing is based on today, we look at jobs, wages, and demand. We look at what people can actually afford right now. But when pricing is based on the future, we're making a bet. A bet that timelines hold. A bet that funding stays strong. A bet that demand shows up exactly as expected. And right now, the entire market is leaning on that bet. Let's make this real. A few years ago, a condo in Fresno might sell for around $350,000. Now, similar units are being listed above $500,000. That's a $150,000 jump. In a market where incomes haven't moved nearly that fast, the average household income is still under $70,000. So we have prices rising fast, while local buying power stays mostly the same. And when that gap grows, risk grows with it. Now let's talk about who's actually buying, because it's not just local families. Large investment firms, also known as institutional investors, have entered the market. These firms manage billions of dollars. And they've shifted away from expensive coastal cities into inland markets like Fresno. Why? Because they see the rail as a long-term value driver. In some neighborhoods near planned rail stations, these firms now own more than 25% of available homes. That means 1 out of every 4 homes is owned by an investor. And that changes the market in a big way. Because these buyers aren't emotional. They're strategic. They're not buying a home. They're building a portfolio. And here's how they decide what to pay. They use algorithm-based pricing models. These systems analyze trends, migration patterns, and projected growth to estimate future value. But here's the key issue. They're not focused on today. They're focused on projections. For example, the model might assume that by 2030, you can travel from Fresno to Silicon Valley in under 2 hours. So it prices homes as if that's already true. Even though today, that same trip can take twice as long. Now here's where it snowballs. One home sells high based on that future. That becomes the new comp. Then the next sale goes higher. And then another. Soon, the whole area is priced on a timeline that hasn't happened yet. Then comes the second strategy. Buy and hold. These firms are buying homes and leaving many of them empty. No renters, no activity, just vacant properties. If we drive through some of these neighborhoods at night, we notice something. Dark windows, empty driveways, very little activity. It doesn't feel like a real neighborhood. It feels like inventory being stored. And that's exactly what it is, because by keeping homes off the market, they reduce supply. And when supply drops, prices rise. That increases the value of everything they already own. It's controlled scarcity. And in the short term, it works. But here's the question we need to ask next. What happens if the story they're betting on doesn't happen on time? Because everything we've talked about depends on one thing: the rail actually being completed. Recent updates point to new delays. One of the biggest issues is seismic safety. Some parts of the rail line may need redesigns. That means new plans, new approvals, and more time. Because of this, some projections now push the first passenger trains past 2030. And that creates a timeline problem. Because pricing today assumes that timeline holds. Here's where this gets even more important. When timelines stretch, costs stretch too. And sometimes funding has to be reworked, delayed, or expanded. That adds even more uncertainty to the entire project. At the same time, development around stations is slowing. Permits are delayed. Utility approvals are backed up. Environmental reviews are taking longer. Some projects are waiting over a year just to move forward. So while we see polished renderings, the real-world progress is slower. There's a gap between vision and reality. Even with these delays, cities are still approving projects. More housing, higher density. Why? Because billions have already been spent. This is the sunk cost effect. We keep going because we've already invested so much. That stopping feels impossible. Now here's where things start to tighten. Prices have risen fast, but wages have not. So buyers are stretching, taking on larger monthly payments, leaning on optimistic projections, and hoping future value makes the numbers work. At the same time, property taxes are based on these higher values. So even if home prices stop rising, or even drop, those tax bills don't adjust right away. They stay high. Now let's stack that together. Higher purchase price, higher monthly payment, higher property taxes, and uncertain future growth. That creates pressure from multiple angles at once. And when enough homeowners feel that pressure, behavior starts to change. Some try to sell early, others hold and hope, but not everyone can wait it out. Now let's walk through what happens if large investors begin to exit. Let's say a firm owns hundreds of homes in one area. As long as prices rise, everything works. But if growth slows, or timelines slip further, their strategy starts to break. So they begin to sell, and even a partial exit can shift the market, because these aren't small players. They control large amounts of inventory. That adds supply. Prices soften. Buyers hesitate, and momentum turns. And once that shift begins, it feeds on itself. Lower prices lead to more caution. More caution leads to fewer buyers, and fewer buyers lead to even lower prices. This is how a liquidity trap forms. Homes are listed, but demand isn't there at those price levels. So listings sit longer. Price cuts begin, and confidence drops. Now we reach the most dangerous phase. Being underwater, that's when we owe more than the home is worth. Let's say we buy at $550,000, but the value drops to $420,000. We're stuck. We can't sell without taking a loss. We can't refinance easily, and our costs stay the same. Now imagine that across entire neighborhoods. That's what we call an underwater hub. And recovery from that can take years. So what should we actually do in a market like this? Because this is where smart decisions matter most. We focus on what's real, not what's promised. We look for real progress. Tracks being built, stations under construction, permits approved. We look at areas not tied to the rail, markets driven by real jobs and real demand, not future speculation. And we ask better questions. What is the real timeline? What delays have already happened? What is actually complete today? Because in the end, we're not just buying a home, we're buying into a timeline. And in the Central Valley right now, that timeline is still uncertain. Subscribe to Housing IQ for real estate insights that cut through the hype.